everyone. It's great to be here. My name is Pattarkine, and I am the Global ESG Lead and Investment Strategy Analyst for CenterSquare Investment Management. And I'm excited to talk to you a little bit about our thoughts around infill industrial and the valuation premium associated with those assets. So infill industrial really has seen kind of a meaningful structural repricing over the last decade. Assets that 10 years ago were trading north of a 7 cap rate today are pretty consistently trading inside of a 4 cap rate, especially in kind of those infill urban submarkets. um, and so at this point, the question really is, whether this valuation is justified and where it's going to go from here. And what we really feel is that the new fundamentals that are really supporting this asset class really support the new pricing regime that we're seeing in these assets today. And we see decades of runway ahead for continued strong performance. So a meaningful driver of this strength in the industrial market has really come from the adoption of e-commerce and the growth that's really changed the value proposition for industrial assets for the retailers that are utilizing these spaces. A logistics facility 10 years ago was just a cost center, and today it's a customer acquisition and retention tool. Because retailers are really competing on that customer experience, which really relies on a supply chain solution that can fulfill customer needs at any time, anywhere. And to that point, about 47% of consumers are unlikely to shop with a retailer again after a bad shipping experience. So creating that reliable and fast shipping experience is pretty critical today for the tenants that are looking for industrial space out there. And then plus transportation really is the largest piece of a traditional supply chain cost structure. It accounts for about 45 to 55% of total costs. And that can be pretty meaningfully reduced with a last mile presence. So this makes infill industrial assets attractive both kind of from that demand fulfillment and cost efficiency perspectives as well. So if you just take Amazon's distribution network as an example, right? They built out first kind of their big box regional distribution facilities, and then from there have shifted their focus to the really infill last mile types of assets to meet the demand they're seeing out there today for kind of that 2-hour same day delivery type of model. And it's taken Amazon over a decade to get to where they are today, and they are arguably the industry leader here, right? So as we see other retailers kind of trying to play catch up, we see decades of runway ahead, especially within those infill submarkets. And this valuation that we're seeing for infill industrial assets is not really just benefiting from these demand kind of tailwinds, but also from a very limited supply backdrop. So in these infill urban submarkets, new industrial supply has been pretty significantly restricted because residential office still kind of offer that higher and better use for that land that's very scarcely available. And then also with industrial assets, you tend to see increased traffic through trucks and things like that. And so you start to see kind of that NIMBYism come into play here as well. And so when you see new development coming through for industrial assets in these kind of infill last mile submarkets, what you're really seeing is kind of redevelopment of existing assets instead of net new supply coming into these submarkets. So for example, urban infill submarkets like Washington, D.C., South San Francisco have been seeing shrinking industrial supply over the last 2 decades. At the same time, some of these lower barrier to entry markets like the Inland Empire have seen supply increase over 116% over the same time period, and national industrial supplies increased about 21%. So the lack of new supply in these higher barrier markets is also really demonstrated, I think, by the older product that you'll see here. Like I mentioned, there's just not a lot of new supply coming into these markets, and the average age in kind of the last mile submarkets that we look at, about 35 years, which is compared to kind of the lower barrier to entry, regional, big box type of markets where you're seeing assets that are on average only 15 years old. The supply demand imbalance really heavily skews this, the state of affairs in the benefit of the industrial landlord today, right? And so it's created this kind of exponential relationship between rental rates and the distance from the city center, especially for some of these high barrier entry markets. And then the last thing I'll really touch on, the value that's realized by retailers who are shifting their focus to these last mile distribution centers kind of goes beyond the hard dollars associated with the strategy. We're seeing customers today becoming increasingly loyal to brands that are seeking to create a positive impact on the environment and their communities. A recent study from the MIT Real Estate Innovation Lab actually looked at the greenhouse gas emissions for e-commerce versus traditional brick and mortar retailers, specifically for kind of this last mile portion of the overall consumption process. And the study found that e-commerce was actually 75% more sustainable. Carbon emissions were about 36% lower than in-store shopping. And then utilizing that urban fulfillment centers can save up to 50% of your transportation related greenhouse gas emissions, which reduces the overall carbon footprint for each of your packages by about 10%. So as we move kind of towards this decarbonization of the global economy, we're really anticipating that urban infill last mile fulfillment centers will be a pretty meaningful part of the solution and command a further valuation premium. So at the end of the day, the last mile infill industrial assets, the value for those has increased substantially as we've seen a very meaningful shift in the way that we demand consumption. And retailers have really begun to respond to kind of their supply chain needs to meet the changing demands. And so it makes sense that we've seen pricing for these assets kind of follow suit. And based on kind of the trends that we're seeing out there today, we do expect that we're going to continue to see these sustained valuations for a while now. If you want to learn more about our strategy associated with last mile industrial, feel free to visit our website at centersquare.com or shoot us an email at contact us@centersquare.com.